The economy with the biggest future potential is definitely the Indian economy. During the last quarter, from April to June, its economy grew by 13.5%. If you want to achieve high level of financial awareness, you must be well informed about this new awakening economic giant. In this video, we'll study the Indian growth, the current prospects, the issues, and the future trajectory. Hello friends and welcome to the Market Watcher, a place for gathering traditional financial and all other knowledge on a regular basis. Subscribe to the channel so that you won't miss out on any of our future content. Leave us a comment down below about which topics you want us to cover next here on the channel. India's economy grew by a massive 13.5% in Q2 of 2022, though during Q1 the growth rate was only 4.1%. The high jump during this quarter is due to the aftermath of the 2020 Q2 negative growth, when the health epidemic was rampant. According to the International Monetary Fund and their data, the Indian economy will grow at a pace of 8.2% for the fiscal year of 2022. Just for some context how impressive that number is, we can take a look at a chart provided via the IMF. For 2022, we see that the Indian economy is expected to grow with a pace of 8.2%. The global economy is expected to grow at a 3.6% level. This means that the Indian economy has double the growth of the global average. Advanced economies, also called developed market economies, will grow at a pace of 3.3%, while emerging markets will grow with 3.8%. What is more interesting is that this is no anomaly. Over the last 45 years, India has constantly been at or around the top when it comes to GDP growth, often reaching peaks of about 10%. The current GDP of India stands at $3.17 trillion according to data from Trading Economics. This gives India the fifth place when it comes to economic power or GDP. Above it in terms of economic power or GDP are only Germany, Japan, China, and the United States of America. Now that we know how India fares up when it comes to GDP and GDP growth rates, let's take a look at some other macroeconomic factors, and this is the demographics. The population of a country is incredibly important. If a country has a declining population, for example, this will negatively affect its economy in the long term. A country needs an increasing population due to the fact more people can work, produce, invent, and so on. Another key demographic factor is not only the size of the population or its growth rate, but the average age. The older the average age, the less the work output. The average age is best between the frames of 25 to 30 years. This makes it so the average people are in their prime working ages. Now that we know the basics of the demographic factors, let's study how they fare up in India. According to data from Statista from the middle of 2021, India is still the second most populous country in the world, with close to 1.393 billion people, while China is on spot number 1 with 1.412 billion. It is expected that when 2023 comes, India will officially surpass China and become the most populous country on Earth. Here it is interesting to take a turn and look at the GDP per capita metric. When we know the dollar denomination of the GDP and we know the size of the population, we can know the GDP per capita. We find this metric when we take the total GDP and divide it by the population size. For India, this stands at $1,961, and on the provided chart we can see how the trend line is going only up. Despite the enormous population growth, the GDP per capita is also increasing a lot. In comparison, China has a GDP per capita of $11,188, while the US has a GDP per capita of close to $47,000. On the next graph, we can see the age distribution of India. 25% of the total population are people between the age of 0 to about 29 years old. This is in line with the so-called Goldilocks zone when it comes to a country's demographic preferences. It is important to note, though, that as time passes, the Indian population's average age will start to become older and older. This can be seen via the next chart by Statista. But what we can see according to their data is that at least until 2040, the Indian population would be around at or about the optimal demographics curve. For example, China, along with Japan and Europe, all have very bad demographic prospects. All of these places have a lack of population growth and a severe risk of too many old people in the near to mid-term future. This will place a lot of burden on their social security systems, and it is possible that their tax systems would have to be drastically changed to the upside. And more taxes leads to less business being started, which in turn brings less economic growth. On the next chart, you can see the average age of the top 20 places, which have the highest average population age. As you can see, the places are filled with mostly European nations, and on the second place, only after the tiny island nation of Malta, is sitting Japan with its massive 100 million plus population. The next very important fact, which indicates whether an economy would be potentially stable or not, is the debt to GDP ratio. The lower this ratio, the better. India has a level sitting at 73.95% according to trading economics data. In the early 2000s, India's levels were higher, reaching their 25-year bottom at around 2010, when the levels were sitting around the 65% level. The average level for the US and Europe is above the 100% mark, so comparing India with these regions, we see that India has a lower level. But in general, anything above the level of 60 is considered to be higher than wanted. When studying the health of a developing nation and talking about its debt levels, it is of crucial importance to study its foreign exchange reserves. Foreign exchange reserves can include banknotes, deposits, bonds, treasury bills, and other government securities. These assets serve many purposes, but are mostly significantly held to ensure that a central government agency has backup funds if their national currency rapidly devalues or becomes entirely insolvent. It is a common practice in countries around the world for a central bank to hold a significant amount of reserves in its foreign exchange. Most of these reserves are held in the United States dollar, since it is the most traded currency in the world. It is not uncommon for the foreign exchange reserves to be made up of British pounds, the euro, the Chinese yuan, or the Japanese yen as well. The latest data from the end of August of 2022 coming out of Statista tells us that the Indian economy has the fourth largest foreign exchange reserves, which stand at $591 billion. On spot number 3 is Switzerland with 964 billion. On second place is Japan with $1.357 trillion. And on first place is China with about 3.4 trillion US dollars equivalent of foreign reserves. The less developed a country, the more foreign reserves it needs to keep its currency and economy stable. The most developed countries do not have high foreign exchange accounts due to the fact they have stable economies and can print money if needed. To examine the level of security which is provided via a large foreign reserve, we must take a look at the reserve to GDP ratio. The higher the level, the better. Anything above 20% is considered to be a very healthy level. The current level of India is sitting at 21%. The highest foreign reserves to GDP ratios are seen in Singapore with a level of 104% and Switzerland with a level of 134%. This indicates their economies are incredibly safe and their currencies are well protected. This data is coming from Lynn Alden's research website. Another key economic indicator to look out for is the inflation rate. The current inflation in India is 6.7%, which is below the inflation seen in Europe and the United States, where the figures are closer to the 10% mark. Also, unlike the West, in India, the differential between the interest rate level and the official inflation level is much less. In order for the inflation to be taken under control, the main central bank interest rate needs to be above the inflation level. The current interest rate of India's Reserve Bank is positioned at 5.4%. This gives India an interest rate to inflation spread of minus 1.3%. If this level is positive, sooner or later the inflation levels would drop. For example, in Europe, the main interest rate is about 0%, while the inflation is at 9.1%. This means the differential is minus 9.1%, which is incredible, and this is the main reason the euro's value is dropping so rapidly in the last several months. In the United States, the inflation rate is about 8.5%, while the main interest rate is sitting at 2.25%. This gives the United States a minus 6.25%, so-called real rate level, also quite a disturbing level. India has one of the best real rate levels globally, which helps it have a more stable financial footing. The country with the best real main interest rate level is Brazil, which is very seriously trying to tackle its inflation problem. According to a report from the State Bank of India, by 2027, India should become the third largest economy, surpassing Germany, and by 2029, it should surpass Japan to become the second largest economy, only behind its Asian rival China. The great Ray Dalio thinks that if China for some reason stumbles on its economic path to global hegemony, India would be close behind to grab the torch and carry on and overtake the United States as the global leader of the financial world. With this, we end our analysis. Thank you for watching until the end. Like, subscribe, and hit the bell icon so that you won't miss out on any of our future value content. Thank you for watching until the end, and I'll see you in the next video.